Okay, well, let's hear it. I'm fascinated with this discussion.
What kind of strategies do you personally use?
I trade in a fully automated way, so I'm not tempted to panic and start making changes to my system when it's losing money, because I've got a realistic idea of what I should make based on a backtest that I trust. If there's a sudden shock to the market goes crazy, and you then cut your position very quickly because the vol estimate is increased. Lengthening your vol estimate isn't really going to change your behavior when markets get calmer, because they tend to get calmer slowly.
But when President Trump announced that it was pretty much a joke, the market calmed very quickly.
And we can look at individual cases where the correct behavior would be to do something else, but the whole point about systematic trading is you look at a backtest, which in my case is 56 years long.
How do you think about regime shifts? How do you measure it? How do you reallocate between trend following and mean reversion?
I don't do any of those things.
Hello and welcome, it's Capital Horizons. I'm Igor Yelnik, and we're speaking today with Rob Carver, and the topic of the conversation is systematic trading in the futures market. Hi, it's very good to have you on the show. Thank you very much for joining me.
No problem.
So you have written books to explain how to make money using systematic strategies in the futures market.
Yes, I've written quite a few books. One of them exclusively on futures, one which covers like other leveraged instruments as well, including like spread bets and CFDs that aren't legal everywhere, and also stock trading on margin, and then a couple of books that are sort of more generic and relate to, not to any specific instruments. But yeah, I trade futures is what I trade myself and what I've got most experience with, certainly, but my books do actually cover other asset classes as well.
What kind of strategies do you personally use?
Yeah, so I guess the strategies I use could be divided into two categories, what you might call divergent and what you might call convergent. So convergent strategies assume that the price has some kind of equilibrium value, either implicit or explicit, and the idea is if the prices dip below that equilibrium value, you'd buy, and vice versa if you'd sell. So the simplest example of that would be a mean reversion strategy on the price itself. So you might kind of look at the price history and say, well, the kind of slow average of the price over the last year, say, has been $100. So if the price go below $100, I would buy. If it went above $100, I would sell. Obviously, you could do that also in relative value space. So you could look at so at the moment we've got quite an interesting thing going in the oil market with the divergence between the Brent crude and the WTI crude futures contracts, which obviously both crude oil, but they deliver in different places because of the supply chain issues with the crude market, which obviously are due to what's going on in the Middle East at the moment. The prices have diverged, which is quite unusual. So that would be an example where you'd say, well, I think those prices are going to converge against each other again. And you can have, many more layers of sophistication. Divergent strategies assume essentially that there is no equilibrium and that prices, if they start moving in one direction, will continue to do so. And most people are familiar with the idea of trend following, which is where if a price has gone up, you assume it's going to carry going up. There's also momentum, which is kind of a similar thing, but cross-sectionally. So if markets outperform, you'd expect it to outperform. So momentum and mean reversion are kind of opposites to each other. So they tend to sort of play out at different time scales. So I tend to trade them with different time scales, because obviously if you traded both, you just end up with positions that cancel out. There are kind of many more flavors to these things, but those are the sort of two basic things that I trade, and those are the sort of main things you could think about within those groups.
We'll get back to those signals and how you distinguish between different regimes in a couple of minutes. But before that, I know that you used to work for AHL, which is one of the biggest hedge funds, probably the biggest publicly traded hedge fund in the world. Do they trade same or similar strategies as you do?
I mean, I haven't worked there since 2013.
Your best guess?
My best guess is they're trading similar strategies to me, but because of their historical, the fact that they started off as a trend following shop, they would probably have a higher weight to trend following as a style, because that's what their clients expect. Whereas I've got a bit more freedom. Obviously, I'm just trading my own money now, so I can kind of set the proportions of my risk capital according to what I think is the optimum without any sort of external constraints. But I'm sure they're doing many more interesting and exciting things than I am. But if I look at the correlation of my returns to their returns, it's about 0.7. So I'm obviously not doing anything particularly that different.
But you do it just flying solo. You do it all by yourself.
Yeah. No, it's just me. Whereas obviously they probably have like 150 people working in their research team.
So what do they do with these 150 people?
Well, lots of things. So I guess one thing to bear in mind is that they're trading a much wider variety of assets than futures. So they're trading single stocks, options, FX forwards, credit derivatives, all kinds of things. So there's obviously additional work involved when you're trading different kinds of assets. They're also probably doing more research than me. I do research at quite a slow pace and make relatively small changes to my models. And that means that probably the kind of loss of performance that I get from my models decaying is maybe slightly higher than theirs, at least in theory. In practice, my returns have been pretty good compared to theirs, but not probably not sufficiently different to say statistically different. And other thing is when you're trading at massive scale, you need to worry much more about your execution and your slippage than I do. So they have a team that's looking at that as well. And then any time you're kind of dealing with other people's money, you've got sort of duties around things like reporting and answering client queries, and then of course selling and so on and so forth. So there's all of that kind of additional, you might call it frictional costs. So yeah, there's a lot more they would have to do as a company than I do as an individual, for sure.
Okay. Now let's get back to the signals. So let's talk about trend following signals to begin with. There have been many books written about trend following, like many. Yours is not the only one. People wrote books on trend following maybe 30, maybe even 40 years ago.
Yeah.
Why is this still working?
Well, one thing you might say actually is if you look at the sort of empirical evidence, it looks like it's sort of something that doesn't work as well as it used to. So the returns from trend following have probably roughly halved, I would say, from the 1970s. So there's potentially a gradual slow decay there. But let's put that to one side and assume they are still working. People have different theories. So I guess the two main theories are what you might call the underreaction hypothesis, which is some news comes into the market and investors take time to process it, and then they only gradually work out what's going on. So if I think back to the 2007-8 crisis, it seemed to me that equity markets were very slow to realize what was going on in the credit markets, and similarly, it seems like at the moment equity markets are really slow to understand what's happening in the commodity markets. So quite often, big trends start quite slowly, and then trend following models have the opportunity to get into those trends as they're building and then make profits from them. The other hypothesis, which I sort of prefer myself, I think, is what you might call the risk premium hypothesis, where essentially risk premium is anything really that academic economists see causes market returns. They don't understand why. So they kind of say, well, it's because people don't like holding those kinds of portfolios. So if you go back to the original work on risk premium, something like the value premium would be because investors like holding portfolios of glamorous stocks with, lousy earnings, maybe high growth prospects. So they tend to overpay for glamour, I guess you could call it. They don't like holding stocks that are cheap, and therefore cheap stocks can outperform. That's the sort of basic idea. Similarly, it looks like people don't really like holding portfolios where things have gone up a bit recently because they prefer selling at small profits and then holding on to losses. So that's sort of an argument. So if either of those arguments is true, well, if it's the underreaction hypothesis, then as long as investors continue to react sluggishly, and you could maybe argue that seems less likely as markets get more efficient. But if investors have the same preferences for things they like and don't like, then that explanation would still hold, and that would be a reason why momentum continued to work.
Great. So what exactly trend following strategies are you using? There are quite a bunch of them.
Yeah, probably 6 or 7 different ones. So we've already spoken about absolute and relative momentum.
Hmm.
So I use, for those I use kind of moving average crossovers, exponentially weighted moving average crossovers. I also have something where I sort of do some kind of simple transformation to the price to make it more sort of a normal distribution before I apply a trend. I use a breakout style strategy where I look at where a price has been in a recent range and whether it's above the middle of the range or below the middle of that range. I use what I would call asset class momentum. So rather than the signal on, say, S&P 500 being based purely on what the S&P 500 has done in terms of price changes, I look at the price changes over the entire equity sector, and then build a signal on that, which then obviously would be the same for all of the components of that index. Yeah, those are the main ones. I probably maybe missed out one or two, but yes. And then of course I trade most of those at different speeds. So fast momentum, medium speed momentum, slow momentum, if you like.
What is fast and what is slow?
Easiest way of thinking about it is in terms of holding period. So slow momentum is an average holding period of, say, a few months. Very fast momentum, you might get down to a holding period of a few days. Those systems tend not to be very profitable, and also they have high costs. So I don't actually have much exposure to them, but in principle they are in my system. And then medium speed momentum would be, kind of sort of maybe 3, 4, 5, 6, 7 weeks, maybe 2 months maximum, that kind of area. There's no sort of fixed rules about these things. That's sort of, broadly speaking, what you would say if you're talking about fast, medium, and slow momentum.
All right, and let's move to mean reversion strategies now. What kind of mean reversion strategies are you using?
So mean reversion tends to work better at timescales that are either too fast or too slow for momentum. So we've already spoken about the value strategy in equities. So people like Warren Buffett, I guess, or Ben Graham use that kind of strategy, and that tends to play out over a very slow time frame. So stocks can stay cheap for years. So I have a mean reversion strategy that operates quite slowly, both absolute and also relative value. So you look at the mean reversion, you'd say, well, if in the last couple of years the S&P has underperformed the FTSE, then you would expect that, them to sort of revert to each other. I also have a carry strategy, and that looks at the slope of the futures curve and basically assumes it's going to revert back to a flatter curve, and makes a price prediction based on that. I have a skew strategy that will tend to do is if there's been a very sharp sell-off in a particular market, it will tend to buy that market because people are scared and don't like holding assets that go down very quickly. And they've got sort of fat left tails, big negative skew. So those assets then become attractive. And obviously I do the opposite with assets that have high positive skew. I'd sell those. So yeah, those are the main, what you might call convergent rather than necessarily just mean reversion strategies.
These things should be quite uncomfortable to trade, right? How do you feel when you lose money?
Well, the interesting thing is they're uncomfortable in different ways. So with a momentum style strategy, you'll tend to have long periods when you're not making money, and then a small number of periods where you're making a lot of money. And with a convergent strategy like skew or carry or mean reversion, you'll tend to have long periods when you're making money, and then shorter periods when you're losing money, but a lot of money. So they're sort of different kinds of pain. And one of the advantages of sort of mixing these two things together is they tend to smooth out the sort of pain. But having said that, I think my longest drawdown in live trading has been like 2 years. So that's 2 years without, being able to take profits out of the system. There's a few things that are important. One is I trade in a fully automated way, so I'm not tempted to sort of panic and start making changes to my system when it's losing money. The second thing is to have a good, realistic idea of what you should expect in terms of performance. So if you expect to make money every month and then you have a 2-year drawdown, then you're going to panic, I guess. But I'm not expecting that because I've got a realistic idea of what I should make over different periods based on a back test that I trust. And my live performance has, touch wood, never sort of exceeded the worst I've seen in my back test. So I'm kind of relaxed about that.
That's remarkable.
And the other thing, of course, is if you're trading your own money, then it's much easier to be relaxed if it's not your only source of income. So I have a trading account, but I also have investment accounts that I can draw regular income from, and I've got other bits of income as well. So I think I'd be more stressed if my trading account was my only source of income. That would be very stressful. I think it would have to be quite a large account. So I was only taking a small amount of it every month to make me relax like that. I think most people will struggle to live full time off purely off trading returns just for the psychological reasons, if nothing else.
But for example, you have a very bad day, whatever a very bad day is for you. For example, you are losing, I don't know, 2% or 3% on a certain day, and you are meeting your friends. Would your friends be able to tell that you are having a bad day?
I'll be honest with you. So this is a habit I've managed to get into over time. So when I first started trading, I wasn't too kind of comfortable. It's a question of trust, right? I've written all the code myself, and although the basic strategies were the same we were using at AHL at the time, and I had a degree of trust in them, I was still uncertain about my implementation. So I did check my P&L every day. But over time, I've got to the point where I'll only really look at it if there's a lot of stuff going on in the market. So, the last couple of months, I have been checking it more regularly, partly because there was a very good run up in trend following performance because of the metals, actually silver and gold. And then obviously we've had the shock from crude oil the last couple of weeks, and that's obviously affected equities and bonds as well as second order effects. So I've been checking my P&L a bit more, but no, it's on average I probably check it maybe once a week, but I could easily go for a month without looking at it, to be honest. So not only would my friends not be able to tell, I wouldn't be able to tell either.
Good. You said something about mixing the signals together, like trend following and reversion, long-term versus short-term. How do you think about diversification between the signals? How do you think about portfolio construction?
I'm a big fan of diversification for sure. You tend to get more diversification across instruments rather than within instruments, by which I mean, if you sort of start with just a simple trend following system on, say, the S&P 500, and you add a whole bunch of other things as well. If you're really lucky, you might increase your expected performance by 80, possibly 100%. But if I go from trading just the S&P to trading the 200 or so instruments I have in my full portfolio, then it's more like a four or five-fold improvement in performance, in expected performance anyway. So there's a much better improvement of performance from diversifying across lots and lots of instruments, which is a problem if you are trading futures and you've got a relatively small account like I have, because futures have big kind of minimum contract sizes, a lot of them, and that means it's hard to diversify across instruments unless you need to really have $50, $100 million, to be honest, which sadly I don't quite have. So I've got some fancy optimization that kind of helps a little bit with that. But yeah.
So how are you dealing with the surrounding error?
Yeah. So basically, what I do is I'll try and make this as untechnical as possible. But essentially, I form a portfolio of what I'd want my positions to be if I could take non-integer positions, which you can't do in futures. So my portfolio might say, oh, you should own 0.0333 Japanese government 10-year bond contracts, say. And then I have an optimization process that will basically look at that portfolio and find the portfolio that matches most closely to it, but has the property that I can only have integer contracts. And what that would probably do is say, well, you know what? Korean 10-year bond futures are quite correlated with Japanese government bond futures. And they haven't got a particularly large contract size, whereas the Japanese government bond contract's got like a $1.4 million notional, I think. So I'll buy, instead of buying 0.033 Japanese government bonds, we'll buy one Korean 10-year bond, and it would do that across the whole portfolio. So instead of having 200 positions, which are all sort of 0.03 and 0.56 and lots of decimals, I'd have maybe 30 or 35 or maybe 40 positions that are just round numbers, which I can actually hold. So that happens on a daily basis, basically.
So practically you are in two optimizations. First, you find your optimal portfolio, and then you find the portfolio which is the closest in some
Well, yes and no, in the sense that the first finding the optimal portfolio is not really it's not actually an optimization. That's not formally an optimization. So that's just going to be essentially multiplying lots of forecasts by some scaling weights, the risk weightings that I've already got and which remain fixed. Those risk weights, of course, will have been found with an optimization, but that's an offline process that happens very irregularly, like maybe every couple of years or something on average. So I actually only run, on a day-to-day basis, I only run one actual optimization.
Okay. So in this one actual optimization, if I understand you correctly, you use some measure of distance between two portfolios, one an ideal portfolio, which is expressed in real numbers like 0.0333 of the Japanese government bond contract, and another one is in integer numbers, which you can actually trade.
Yeah, that's pretty much it. Yeah.
All right. Now, do you use some kind of volatility scaling or volatility targeting?
Yeah. So all of my positions are basically scaled so that on average they would all hit a given annualized volatility, and then my system as a whole has sort of additional leverage factor applied, because obviously unless my positions were perfectly correlated, I would always undershoot that because of diversification effects. So if two assets have a zero correlation, then you'll undershoot your risk by the square root of 2. So instead of having risk, if suppose your risk target is 14.14%, which obviously is a very odd number chosen deliberately, and you had two assets that were independent, then your realized risk on your portfolio, assuming they were equally weighted, would be 10%, which is 14.14 divided by the square root of 2. So I have a number like the square root of 2. It's actually more like 4 or maybe even 6. That sort of normalizes that out. But yes, so yes, I am on every instrument then forming an estimate of what I think the future volatility is going to be, and then scaling the position inversely so that I hit a vol target.
How do you forecast volatility? On what kind of windows?
Yeah, so I use broadly speaking, it's like the last month of volatility. But I also have a mean reversion component. So volatility tends to be kind of sort of stable in the short run. So a very good estimate of next month's volatility is last month's volatility, but it also has a mean reverting component. So volatility is currently very high. It will tend to mean revert back to a lower level. So I have a short-term volatility measure combined with a much longer look back that acts as a sort of mean reversion. So but it's mainly sort of mainly weighted towards the more recent volatility of about a month, which is if you look at you can do some graphs and sort of compare different windows, and for my average holding period, that's roughly the sweet spot. If you had a shorter window, you might want to bring that window down a little bit, but broadly speaking, that's roughly where most where it should be.
1 month long window would make your volatility estimates very, very noisy, and as a result, you will be practically trading this noise.
So I'm using exponentially weighted window, so that smooths it to an extent. And I've done some work, and basically, well, okay, so there's a couple of things. One is I've done some work that shows, and I should have proved to myself that if I was to say lengthen that volatility estimate, like you say, it would have no effect on the final turnover of my system, because that's dominated essentially by the turnover of my forecasts. Not sure if I'm explaining that well, but basically lengthening my vol window would not actually help in terms of reducing turnover. It would have no effect at all. So it's better to set it where I can get the optimal volatility forecast, which is about a month. The other thing to say is that I've got like a sort of buffering on my final positions. So I won't change my positions if there's only a small change in the target position. So that means that, if the forecast only changes by a little bit or the volatility estimate only changes by a little bit, then the position will stay the same. So that also dampens turnover down. So the combination of those two things means that I disagree with you.
Okay, good.
One month is fine, and lengthening it to sort of reduce turnover would bring no benefits and probably costs as well.
It's interesting because if you think about calm times when nothing is happening on the market, then it doesn't really matter. When you have a month like April 2025 or March 2026, it probably matters a lot. And a more conservative volatility forecast will surely make you trade less.
Well, no, because if you think about those two examples, those were examples also my forecasts were changing very quickly. So, a huge amount of my trading was caused by my forecast changing. Very little was caused by, in comparison, the volatility had very little effect. The only time the volatility is going to have an effect is if you have a really weird corner case where your forecast remains unchanged, but let's say your volatility, imagine your volatility doubles, your volatility estimate doubles, right?
I can easily imagine that.
Yeah, so let's suppose your volatility doubles. So which, over a month could I think it's quite likely your volatility's easily doubled in many markets, both in the last month, but also last April. But so you've got a situation where your volatility's doubled, but where nothing at all has happened to the price. Because if the price had done something crazy, then the forecast would have changed as well. And that's going to lead to much more trading than the volatility changing. So I'd argue it's a very tiny edge case where, you somehow have something happen that has no effect on your forecast whatsoever, the quantum of your forecast. The only thing I could think of would be if the market suddenly started veering. Actually, I can't think of any example, to be honest, where if I'm where it just seems unlikely. Like, maybe for an individual trading rule that doesn't have price as a direct input, so maybe carry. So conceivably, even carry wouldn't happen, to be honest. Yeah, I'm struggling to think of a case where in a market the volatility doubles, but my forecast remained completely unchanged. I can't think of one. So I think it's not something to worry about, to be honest.
Okay, actually, I can think about some examples.
Let's hear it. I'm curious. I'm fascinated with this discussion. Give me an example.
Okay, so let's imagine that volatility halves.
Yeah. So your position would double.
Your position would double.
Yeah.
Yes. And let's imagine that at the same time, you believe that you are currently in the trend following mode. So the market.
Okay, yes, I'm trend following. Yeah.
You're trend following.
Yeah.
Volatility halves. So slowly, your market is going, let's say, up, for the sake of the argument.
Yeah.
Very calmly, therefore volatility goes down, right? And you are doubling your position, not because your trend is changing. Your trend is not changing. It has remained pretty much constant.
But my trend, sorry to interrupt you, but there's actually a second order effect here because my trend signals are also risk adjusted. So if the market started going up the same kind of gradient, but with less volatility, then I would double my forecast. My forecast would increase irrespective of my volatility scaling. So position really is price change divided by volatility square, sigma squared, effectively.
Which only makes the effect I'm talking about more significant.
Yes, yeah, I agree. So I was thinking of examples where the volatility increased, but you're right. I can think of scenarios where the volatility would reduce, but the forecast would remain unchanged. So that's where I think I would sort of say that the longer term volatility estimate comes in, because if volatility goes, let's just talk about the S&P, because we kind of have an intuition as to where the vol should be on that, right? Say the vol on the S&P goes down to, say, 8% estimated. then my actual vol estimate would be higher than that. It might be like 12%, say, because I'm bringing in a longer term vol for the S&P of like an average of 16% or 18% or something. That's going to pull that one up. So that would result in the positions not increasing by as much as you might expect. But yeah, I mean, so if I change my volatility, I mean, ultimately, what am I trying to do? I'm trying to predict volatility, right? The best estimate of volatility over the next 30 days is broadly speaking the last 30 days. So if volatility has fallen to the extent that my position's increasing, like you say, then the correct thing to do is to increase my position. Now, the original discussion was you were saying it would lead to more trading costs. Well, actually, the example you've described where volatility falls a lot and prices kind of continue to trend up, I would imagine that would probably happen quite slowly. So that wouldn't lead to a trading cost. I think the trading cost trading costs due to volatility estimates being too short are much more likely if the volatility spikes, right? If there's a sudden shock to the market goes crazy, and you then cut your position very quickly because the vol estimate has increased. So, lengthening your vol estimate isn't really going to change your behavior when markets get calmer, because they tend to get calmer slowly.
Not always, right? Again, if you remember, and I'm sure you do remember, April 25, post-Liberation Day, the market went berserk immediately after the announcement.
Yeah.
But then when President Trump announced that it was all pretty much a joke, the market calmed very quickly.
Well, it calmed, and actually, if you look at the price, it basically did a V shape, right?
Yes.
So the volatility estimate, what the volatility estimate would have done would have done that, and then come back down again.
Yes.
Yeah. So you would have cut.
Also quite quickly.
Yeah. Well, in my case, quite quickly, because I've got a 1 month rolling window. So during that period, you would cut your positions. Yeah. You'd cut your positions actually for three reasons, if you like. The two reasons, because of the two volatilities on the denominator we've already discussed, because the volatility has gone up. So broadly speaking, you cut your position by vol squared. But also, if you're a trend follower, you would have probably been long going into that. Where you'd have cut your position drastically because of the market moved against you. And then because the price did that, your trend signal coming out of that would be probably getting close to flat anyway. So the correct position to have would be a zero, ultimately would have been a zero position. So the fact that you reduce your position drastically because of vol spiking, I don't think is the end of the world.
Okay.
Yeah, I mean, ultimately, we can look at individual cases where the correct behavior would be to do something else. But the whole point about systematic trading is you look at a back test, which in my case is 56 years long, and you do whatever is the correct thing to do over the entire back test, not just kind of focusing on little events here and there. Because to be honest, that's how you end up overfitting your system, which we can spend many hours talking about if you want.
Sure. Nevertheless, I would like to dwell a little bit on April 25, because that event, that month, was a blow in the face of trend following managers. Practically all of them lost tons of money at that time. And this also led to some increased doubts of institutional investors, and not only institutional, of many investors, about trend following strategies and their role in their portfolios.
Yeah.
You know that trend following strategies have been sold as crisis alpha, thanks to the brilliant phrase coined by Katie Kaminsky.
Yeah.
But here is the crisis. There is alpha, but it's a negative alpha. It hurts the portfolio even more, exactly at the time when people expected it would help them. So what do you think about that?
Oh, I think so many things. So I mean, I think it's. I'm not going to get into a discussion with what semantics Katie's used, because I like Katie and we're good friends.
Me too.
But I think it's a mistake to kind of put trend following into the same bucket as something like a sort of pure tail hedging strategy, which would for sure make money when markets move against you. But the cost of that, of course, is that on average those strategies will probably lose money when times are good, right? So trend following is more a strategy that in the right kind of crisis will make money. Now, obviously, any crisis that, what's a good crisis of trend following? Well, a good crisis of trend following is where, the crisis break, as I've discussed, the crisis kind of breaks gradually and there's a slow realization, and then the realization builds and the market continues moving in the other direction. So that I've described 2008 to you perfectly there, I think. The worst kind of crisis for trend following is where there's a brief episodic, oh my God, the world's going to end, and so everything's going fine, and then there's a sudden change in sentiment, and then worse than that, a sudden change in sentiment in the reverse direction, like a week later or whenever it was, if you speak about that specific instance. So there's not really any way to sort of change your trend following strategies to cope with that kind of event, to be honest. All you can do is, for example, ensure you've got sufficient diversification across, say, speed, because certain trend following strategies would have been whipsawed by that, right? So if you're trading very fast trend following and you basically would have sold, you'd have sold at the bottom of that downward V and you'd have bought at the top, you'd have got smashed to pieces. People who are trading very slow trend would have almost not noticed it because they barely would have adjusted their positions. So that's kind of, you can't really design this stuff out. You can only make your system robust to as many different kinds of environments as you possibly can. So that means basically, if you want to have trend following in your portfolio as a diversifier, I would say what I would call an average diversifier. So rather than focusing on tail events, saying, well, on average, the correlation of trend following with many other strategies is low. Obviously, over long periods of time, obviously there are periods of time when it would be positive. That's fine. And if you look at, various crisis events, various crisis regimes, then in many of them, though not all, of course, it has tended to perform well. But that doesn't mean it's a substitute for pure tail hedging. Of course, one of the other things is that if you look at, I'm not sure, I've not looked at indices overall, but if I look at my own performance from like April the 20th to today, I've had one of my best, years, basically. Not quite a year now, but whatever it is, getting up to 11 months. So anyone who kind of did at that point say, oh, trend following's rubbish because it's lost a chunk of money, I'm going to get out of my position entirely. That would have, as it turns out, been a mistake. And that's not for me that's not because I'm necessarily defending trend following. I just think that people should make asset allocation decisions based on lots of data rather than just on individual events and short periods of time, which obviously may or may not be favorable for a given asset class or strategy.
What do you think about a number of papers which were released around last summer? Some of them, I think, were released by your former colleagues at AHL, where people were trying to say that actually, trend following strategies tend to perform well after sharp drawdowns. In this instance, they happen to be right.
Yeah. But I've done some work on this myself. So I've looked at basically what you want to look at is like the autocorrelation properties of a strategy at different time intervals. Now, one thing you've got to be careful is if you do this using public funds, the sort of the fact that you don't pay performance fees in a drawdown actually introduces some autocorrelation bias. If you strip that out, then the results that I got personally are very weak indeed. So it doesn't look to me like there's really, enough evidence to say, oh yes, the best time to buy a trend following fund or strategy is if it's gone down in the last 12 months or if it's, gone up in the last month or any other thing like that. I just, we're talking about relatively long periods of time. I don't think anyone's suggesting you should be moving in and out of your funds once a month. So, you need to look at autocorrelation properties over much longer periods of time, like at least a year. There just aren't that many data points, even with a 56-year backtest. There aren't that many data points, and the effect is so weak that I personally don't really, it's a kind of a nice marketing thing to say, but I think there's a big difference between finding a statistically significant effect and looking at maybe sort of 8 or 9 episodes and saying, well, most of these episodes it did well afterwards. That's just my opinion.
Yeah, actually, my opinion is very similar, and we also ran some research on it, and unsurprisingly, its results are very similar to yours.
Yeah.
Which is why I was surprised to see this flurry of papers saying the opposite. I thought,
I
okay,
mean, you asked me what the 150 people are doing. Well, one of the things they're doing is trying to get people to either stay in or buy the fund. Whereas, I don't have to do that. My one investor is happy with the fund and is happy to stay in it. So I don't need to write papers convincing myself that I should carry on doing this thing. I think it's as a general rule, if you're writing a paper saying, well, you should not panic and get out of something just because of a short period of poor performance, then that's fine. I think that's absolutely a message that we should be selling to everybody. But if you feel you need to go further and say, well, it turns out that after a period of poor performance, it's actually even better. Well, to me, that's I can't find enough evidence of that myself, and that sort of level of argument is not required to persuade me, but I can understand why it would be required to persuade some institutional investors who obviously felt they needed to be told that story, but it's not a story I need to be told. So,
okay. Now let's talk about regimes. There was a major regime shift in 21, 22. I'm not sure if we are surviving a regime shift now. How do you think about regime shifts? How do you measure it? How do you reallocate between trend following and mean reversion?
I don't do any of those things.
So you just have stable allocation, same volatilities, basically vol parity type of strategy, where you put same constant amount of risk.
Yeah. So I've looked at regimes a lot. I've found two very weak regimes. One specifically in fixed income related to interest rate levels and changes. But that was when I was just trading fixed income. And that's pretty weak. And I found a better, a more consistent one related to volatility, back to our favorite subject. And basically, it seems that trend following quite strongly and carried to an extent, although not as much, does seem to perform better when like a lower vol regime, like in a quieter regime. So I'm reminded, actually, I was at a conference in Oxford, and this was back when I was working for AHL, and the professor came up to me and said, how are you guys doing? The market's been very volatile recently. Surely you've made money. I said, well, unfortunately, it was the wrong kind of volatility. And April last year was the wrong kind of volatility as well. So it's not necessarily the case that you'd think that a strategy that expected divergence would want high risk, but actually what you really want is probably an environment where the market's very quietly going in one direction or the other. That'd be ideal. So I actually use that second effect. I do actually have that as a regime. So what that would do is essentially attenuate and sort of turn up or turn down within a range, not completely. So we're talking about multiplying by 0.5 or 1.5 or somewhere in between the underlying signal if the vol regime is particularly high or low. But otherwise, I've found no evidence of any other kind of exogenous regime or endogenous regime that I, without sort of massively overfitting, that produces any kind of significant effect. So I prefer to keep things simple and not think about regimes at all, to be honest.
How do you think about aging of your signals? What I'm going at is that you have a number of signals in your strategy. I don't know what the overall Sharpe of your strategy you get, but let's assume it's 0.7, 0.8, or something like this. And you have a bunch of signals. When you combine a bunch of signals to get a Sharpe of 0.7, 0.8, it means that those individual signals are very weak. They may individually have Sharpes of like 0.1, 0.2, and 0.1, 0.2 is virtually indistinguishable from zero. So how do you know that those signals have quote unquote stopped working?
Yeah, so I'd say those numbers are broadly correct, except that obviously the 0.7, 0.8 is like my live performance the last 10 years, say. In backtest, it's higher, as you'd expect. And therefore the backtested Sharpes are also a bit higher. But you're right. I think it's unless you've, certainly at an individual signal level, you're never going to have enough data to distinguish it from noise. Absolutely not. I think once I think if you aggregate up across instruments, maybe, so you look at trend following across 240 instruments at a particular speed, say, you going to get a better sharp and potentially be able to distinguish it from zero. But yeah, I mean, this is why I've never really turned anything off because there isn't statistically significant evidence to do this. So the way I think about it is like this: if you're doing a back test in the correct way, which means you're only ever using backward-looking information, then the weights you're allocating in your portfolio will only be zero if there's a significant evidence that something's rubbish, right? So that means not even a sharp of 0. It means it's going to have a negative sharp, and a negative sharp big enough, to sort of say you definitely have to throw it away. And there aren't many things that I trade that have that kind of sharp that bad. So I'd probably never get rid of anything completely. But obviously, any sort of the portfolio optimization will downweight things that are done badly. It's just that downweighting will be happening much more slowly and to a lot less of an extent than you might expect. Whereas, discretionary traders, or well, let's call them sort of semi-systematic traders, might look at a back test of a signal and say, well, that's not worked for the last 12 months. I'm going to turn it off. Without really understanding the statistics of whether that's the correct decision or not. Whereas I'm sort of obsessed with this stuff. So, it helps, or not helps, but obviously I think people confound what I do with, say, what a high frequency trader would do, where you're not talking about sharps of 0.1, 0.2, you're talking about sharps that are sort of high single digits, and where the decay is real and it's happening over weeks or months. So that means you're in a situation where your signal will definitely stop working. It will stop working quite quickly, and you will see statistical evidence is stop working quite quickly as well. So it absolutely makes sense to have a system so that we monitor these things and go, well, actually now this is at the point where statistically I can turn it off, because it was a sharp 6 strategy and now it's a sharp -1, and that's a significant difference. So off it goes. But yeah, it could be decades before I know for sure whether some of my signals really aren't working anymore. And that's just the game that you play with, as you say, with weak sharps.
So some people would say that you are falling in love with your signals. You just stubborn, and you don't want to retire them, even though it's quite clear that these signals are indistinguishable from zero.
That's an interesting point. I'd say, I can sort of see that, because I guess if you spent time researching and coding something out, it's disappointing when it doesn't work. I think more of a danger actually is that you spend time researching and coding something up, and then the first iteration of it doesn't work when you backtest it. And then potentially you then overfit it to make it work, because you don't want to kind of have a sunk cost of throwing stuff away. So I think that's probably more of a danger, to be honest. It's not that I've fallen in love with my signals, but my optimizer hasn't fallen out of love with them. That's the more correct way of saying it. So, I'm not going to delete anything unless I have statistical proof it stopped working. That's unlikely to happen. That doesn't mean I won't downweight things if they do sort of stop working over time. But that's only ever done in a proper statistical way, rather than just flippantly turning it off because I don't like it anymore.
Okay. How do you trade about major announcements about political events like president elections in the US, for example, which will have a binary results, about binary outcome, or Brexit? Would you keep trading even though you know that it's just a coin toss?
Well, I'm not really betting on those events specifically, am I? So, also I trade a very diversified portfolio. So, the impact of there aren't many things that would cause a coordinated response across all of my markets. Brexit basically affected, a couple of exchange rates and the UK bond market and the UK equity market. So it's quite, which might be like 0.8% of my portfolio, perhaps. But that's, being a bit flippant. It's, as a systematic trader, it's very difficult to manage these things, because strictly speaking, you need to have a database of binary events in your backtest and then work out how you traded them without future information. A reasonable thing to do is to say, well, if you're going into a binary event, then your backward-looking vol estimate is going to be biased downwards, because it doesn't know about the, backward-looking vol doesn't know about the fact that there's a big binary event happening that's going to mean the price is going to do this or this, So that's not going to help you with something like the Euro Swissy depegging because everyone knew it was kind of coming, but nobody knew when. Whereas, of course, elections and Brexit and non-farm payrolls, we know when they're coming, so that's nice. So what you would do is use implied vol from the options markets and use that and combine that with your existing realized vol signal, because the implied vol obviously is going to be higher at the appropriate maturity, and that will tell you that yes, the markets are quiet at the moment, but they're going to be very risky because there's this thing happening in a week that's going to mean, as you say, yes or no. If I was running an institutional sort of level of AUM and with lots of people, I would absolutely do that, but I'm not. So collecting, lots of options prices and working at implied vol from them is going to be a huge amount of work just to get a slightly better vol estimate. So I don't do that. So in practice, the answer is my same answer to regimes. I just don't know or care about. Or my system doesn't know or care about these binary events. They just happen.
Okay. That's understandable.
Although I have to say, I did make quite a lot of money betting on Brexit because I think the odds were 5-1, and to me, even though I was hoping it wouldn't happen, I thought that was a very rich price. So,
yep, because somehow people didn't believe it was going to happen.
Yeah,
which was strange because it was very clearly a binary event, and the margin was very thin.
I would say I was putting a 40% chance on it happening, and so a 20% chance was crazy. Anyway, let's move on because that wasn't systematic.
Yeah. I think we're running towards the end of this conversation. And my final question to you is, what has been your biggest mistake as an investor?
I mean, it's very easy I think I've made a lot of mistakes as a discretionary investor, that's for sure. I mean, like, for example, last April, my system carried on trading, but in my sort of long-only book, I closed all my equity positions and missed out on quite a nice rally. So, that's probably the most recent one in my head as a discretionary investor. As a systematic investor, I've made so many mistakes. It's hard to pin one down. Fortunately, none of them have been career-ending or like AUM ending. So, yeah. I think I do think overfitting is the thing that most people tend to fall into, and I end up doing it myself, even with the best intentions. I would say the three main things that can make you go bust as a systematic trader are overtrading, paying too much in trading costs. I'm pretty good at that and not doing that. I've got, because it's very easy to quantify and predict trading costs and work out how to optimize your strategy in the presence of them. Using too much leverage is a second one, and again I'm pretty good at that. But it's much harder to avoid overfitting. Every time you do research and look at historic backtest, you risk it. So that's the thing I'm always watching out and trying to avoid doing, and so it's probably the sin I've committed the most in the past as well, to be honest.
Okay. Rob, that's really great. Thank you very much for your time. It was a very exciting conversation, and your insight is just amazing. Thank you very much.
Oh, thank you. No, it was a very enjoyable conversation. I quite enjoyed it. Thank you.